So if you take a look at the overall indices, your S&P 500s, your Dow Jones, your tech-heavy NASDAQ, this looks like a very healthy market that on a regular basis is making new all-time highs. Maybe this is driven by heavy ETF investing. Maybe there's some other factors behind it, but the fact remains that the market does look strong. But if you dig down a little deeper, you try to understand what's pushing the market higher, you'll realize very quickly that there's only a small subset of the market that's really driving most of these gains, and that the majority of stocks are actually dragging us down quite a bit. Now, if you've been a subscriber of this channel, and if you haven't, subscribe right now, hit the like button as well. You guys know that I've been focusing the last few months on building out strong positions in my portfolio. I've been very vocal about building Salesforce, one of my top positions. Tesla, of course, is my number one position, which I added to quite heavily earlier this year. And I added a ton to Amazon. I increased that position size quite significantly. So these stocks are right at the top of my portfolio in terms of size, and they've been helping my portfolio push new highs as well. Ironically, these are the same stocks that are helping push the indices higher simultaneously. So, I kind of understand the perspective of, if you look at my overall portfolio, things look absolutely fine, but you really need to pay attention to your individual stocks, some of these smaller companies, because that is where the actual, pain is being realized right now. But here's the thing, I want to be upfront with you guys. I'm no stock guru, you should know that by now. I'm just sharing my opinions here. And while I've made good decisions on, beefing up my Amazon and adding Salesforce and these kind of stocks, it's panned out well, I have my fair share of dogs in the portfolio. As you know, I cut Peloton recently. I'm down on my Beyond Meat position. Splunk is starting to drag down the portfolio a tiny bit. And then of course, Alibaba today down 10%. That's also a part of my portfolio. The key though is that all of these stocks I named make up a fraction of my portfolio versus the ones that are, pushing new highs. Those stocks make up a huge chunk of my portfolio. So when they move, 2, 3, 4% in a day or something like that, it pulls up the whole portfolio despite what these smaller positions are doing. So I just want to be clear with you guys, while I have a ton of winners in my portfolio, there's also a bunch of losers in there that are pulling me down right now. And eventually over time, I believe these are still good businesses, so they will recover and will contribute to new highs at some point. And really, this is where the whole shift has happened over the last month and a half in the market, really. Most of 2020, most of 2021 has been invest in these high growth speculative companies. They'll just go to the moon. It's a no-brainer investment, easy to make money. And a lot of people double, triple, quadruple their portfolios over this time period. Congrats to them. But this environment that we're in now is very different, and it's absolutely crystal clear to me now that these high growth companies that were once high flyers are now the ones having a drag on our portfolio. The market is no longer rewarding these speculative high growth companies, and it's focused once again here on the best of breed, top of their class businesses. Roku here is an example of one of these speculative stocks, a hot stock earlier this year that is now down 50% from its highs. Peloton, which is a stock I used to own, made new highs earlier this year and is now down over 70%. Teladoc, a popular ARK Invest stock, is down over 58% from its highs. And this thing hit $300 per share earlier this year and now sits in the 120s. And this is the trend for many, many more of these growth type stocks. I don't have to, bore you guys with the details. I'm sure a lot of you hold some of these stocks in portfolio, so you know what I'm talking about. If you look at this map here that I've pulled up, you can see that while the largest players in each sector, for the most part, are bright green and in many cases flaunting double-digit gains here year to date, we can see that there's many, many pockets of the market that have seen red and deep red, and that's where a lot of us have our exposure to some of these more growth type stocks like Peloton, Roku, for example. And we can see here that they're so small you can't even see where they lie in this chart here. But again, if you take a step back and just look at its high level, I see a lot more green on the screen than I do red, which is why we see the market still at its highs. Another interesting stat that I look at quite regularly is how many stocks are making new lows and how many of them are below the 200-day moving average. And we can see here that the majority of stocks, guys, are making new lows, and about half of them are below their 200 moving average. The 200 moving average, for those not familiar, is kind of seen as like the last line of defense when you're looking at kind of short to medium term, because that's where stocks typically find their final support if they're going to see a bounce higher. And typically if they break through this, especially if it's with good volume, that is seen as a very bearish signal. So what we have here is about half the market showing us a bearish signal, and about 2/3 of stocks making new lows. Yet, as we said before, the indices are still pretty much at their highs. This is an absolute crazy world that we're in right now when it comes to stocks, and now more than ever, it's extremely important to be very selective with your stock picking. You know, if you just got in the market over the last year and a half, it's been a pretty easy ride. A lot of us made good money in the market, but now fundamentals matter, valuations matter, and companies that don't really produce much in terms of cash flow, profits, that kind of stuff, the market is absolutely kicking it to the curb. If you pick the wrong stocks at this point in time, you are going to have a tough time even trying to break even here on the market, because we're seeing huge selling almost on a daily basis with some of these stocks, and it doesn't look like that's going to end anytime soon. Now, luckily for me, and hopefully for those of you that have been watching my channel, you've kind of been beefing up on some of these larger, more stable businesses like your Amazons, for example, and that has helped you weather through this turbulent storm that we've been seeing the last month or so. But guys, here's the thing. While these extremely, lucrative quality businesses are holding us together right now, it does not mean that they're going to be doing this forever, and they could definitely falter. We could see some selling start to pick up in those stocks, and if that happens, that is when we're going to see the broader market pull back. That is when we could see, a lot of fear set into the market, a lot of questions about, oh, should I take my profits and run? That's when the aggressive selling really starts in the broader market, and those growth stocks that are already down 30, 40, 50% can definitely go down another 20, 30, 40% from where they're at today. If you're new, when the broader market sells off in general, the lower quality stocks get hit the hardest. Now, at the end of September and beginning of October, the market did see a correction, and it was the biggest correction actually of 2021, and I believe that is when the whole narrative changed for the market. Since then, I believe that the market has started accounting for and pricing in the changes that are going to get into effect in 2022. The Fed recently announced that they are starting tapering this month, probably already started right now, and they're going to continue this into early 2022 when they'll finally end tapering. And at that point, we could see interest rates start to rise once again. Now, when this happens in the market, the stocks that are hurt hardest from all of this are your speculative names, your names like your Teladocs, your Rokus, your Pelotons, Beyond Meat, for example. These stocks, the market wants nothing to do with these companies because they don't generate a bunch of cash. They have a hard time making money when, borrowing and that kind of stuff is a little tougher to get to. Their interest payments start rising on the debt that they have. And it's overall just not the environment for those companies to thrive. We've already seen some extreme volatility this earnings season. I'm sure most of you guys hold at least one stock that saw a pretty decent pull down here after their earnings report. A lot of companies saw their stock drop -20, -30% over the last month or so. And that, I believe, right there is a perfect example of the market pricing in the future for these stocks, at least over the next few months to a year. In my opinion, the narrative is if the companies can't make money right now in this good environment, they're going to struggle even more in a tougher environment, which is why they're less desirable to hold. But anyways, guys, so despite the general YouTube community seeing a lot of their favorite stocks down quite a bit here from their highs, the overall sentiment with the market seems to be near a high point, showing signs of extreme greed. And this can be seen directly in rallies from companies like Tesla, from Rivian, Lucid, semiconductor companies. A lot of these companies are seeing some euphoric runs, and if you're only investing and playing around with those companies, you've had the time of your life. You've been making a ton of money these last few weeks. Not to mention the IPO market is still pretty hot. A lot of companies that are IPOing are seeing massive runs in their stock price as well. This is where a lot of retail investors, especially newer investors, want to play in. So to them, things still look okay. But to those of us that are long-term investors, actually have, good businesses that we hold in our portfolio, we can see a wider range of what's actually happening right now. So that kind of brings us to our million-dollar question for this video. Are we entering a bear market here in 2022? Well, if you've been following along this video closely, you've probably realized something. A lot of these stocks are already in a bear market. They've been in a bear market for majority of 2021 for a lot of them, and they have seen extreme selling already. So arguably, I would say we're kind of in a bear market already, especially when it comes to high growth stocks. Now, unless your portfolio only consists of like your Home Depots or, Lowe's and Palo Alto Networks and these companies that are just pushing highs, you definitely have experienced somewhat of a bear market in your portfolio, even if it's a small subset of it. But just remember what I said earlier. The big companies are holding us up right now, and if they see some weakness, if they start to sell off, that is when we could see kind of a more broader bear market, and that is when we'll see a lot of these issues that are kind of under the covers start to pop out. But here's kind of the flip side, a little rebuttal to this sort of thinking, right? For investors to pull out money from these top quality stocks, they need somewhere to put that money to, yield them better results. And typically that would be to something like bonds or treasury, stuff like that. But this may not be the environment yet for that to happen. The 10-year is a good gauge, and we can see that it's currently yielding around 1.591%, which is still well below what it was in 2018 or early 2019, but it's much, much higher than it was about a year ago. So this kind of explains why we're seeing a lot more uncertainty now, if you will, with some of these stocks than we did a year ago. Now, as this continues trending higher, as the yield continues rising, it becomes more and more attractive to investors for a most safe and consistent investment. And that is when we can see some of these big dogs like your Apples, your Amazons, your Googles start to sell off and show signs of weakness as money flows out of these assets and go into things like treasuries instead. So in my opinion, I don't think that's happening yet because rates aren't as attractive yet. If they continue rising into 2022, then we could see a lot more of this starting to happen. And one thing that you guys should monitor is if we start to see these large tech companies sell off, say they sell off, 10, 15% off their highs, you want to try to figure out where that money is going, try to do some research, try to figure out what asset class it's going into. Maybe it rotates back into growth stocks. Who knows? But that's always a good indicator as to, the overall health of the market and kind of where the market wants to go in the next, say, few months to a year. And really the bottom line is what's happening in the market right now is absolutely ruthless. It's cutthroat. If you are a company that reports disappointing numbers, profit loss, negative EPS, you could say goodbye to your gains in your stock because it is going to see an instant sell-off of like 10, 20, 30% like we've seen in so many stocks. The difference though is if you have these high quality companies, even if they sell off, they get bought back up pretty quick and a lot of them are pretty much at their highs once again. So what I'm doing right now, guys, is the same thing I've been doing for the last few months. I've been focusing on the highest quality businesses with strong free cash flow. Visa, for example, is a good example of a company that's suffering right now. It's kind of being pulled down a little bit, but it meets the criteria for a strong business in higher interest rate environments and a tighter monetary environment. I think that Visa will be just fine. It'll rebound at some point in the future. But I'm also going to still focus on my favorite names like Facebook and Tesla and Nvidia and those kind of companies as well, because those companies are just proving that it doesn't matter what the macro environment is, they're going to keep chugging along just fine. Now, also what you could consider doing is if you think a bear market in 2022 is possible, which I think there's a good possibility of it happening, hedging your portfolio with options and, spreads is probably not the worst idea. Through this earnings season, I did hedge myself for some earnings like Peloton and Beyond, for example. Those are the big ones. And those hedges paid off quite handsomely. So I could definitely see the value of hedging if you're kind of unsure about how your portfolio is going to do over the next, say, few months or year. And if you want to learn more about options and how to hedge and how to look for opportunities to make money to the downside, consider joining our VIP group. I'm pretty active on there on the Discord with options and option ideas and trades. So check the description down below if you want to join in. But I think for now, the bottom line is whether we enter a bear market or not in 2022, just focus on your portfolio, focus on the best businesses, cut out those low quality businesses because you do not want to ride them through a downturn, especially if we see the broader market pull back as well. That's all I'm going to say. Anyways, guys, hope this video was a bit insightful. If it was, like button down below, smash it, and leave a comment as well, letting me know what your plan is here for 2022. Are you just going to keep buying your stocks? Are you going to buy some of these beaten down growth stocks? Are you going to focus on high quality businesses? Let me know in the comments down below. But either way, guys, thank you so much for watching. Don't forget to invest positively, and I'll see you in the next one.